When business partners withdraw money from their firm for personal use, that money is categorized as drawings. And just as a firm pays interest on capital contributed by partners, those partners must pay interest back to the business for any funds they remove. Think of it as capital draining from the central business to fund personal needs. To keep the partnership equitable, the firm calculates exactly how much that capital would have earned if it had stayed in the business. Today, we will master 3 distinct ways to calculate that cost: the simple method, the product method, and the shortcut method. By the end, you will be able to identify the most efficient path for any withdrawal scenario an exam presents. To ensure accuracy, we must establish a temporal baseline. In these problems, the standard financial year runs strictly from April 1st to March 31st. Every calculation depends on the number of months between the withdrawal date and that March 31st closing. While accuracy is the primary goal, these methods focus on speed. On a time-crunched exam, the difference between a 3-minute calculation and a 30-second one can determine whether or not you finish the paper. Consider a scenario where a partner makes 4 unequal withdrawals at random times throughout the year: $20,000 in June, $10,000 in August, $18,000 in October, and $12,000 in February. The traditional approach is the simple method. This involves calculating the exact months remaining in the year for every single withdrawal and running the interest formula individually for each one. This table illustrates the workload. You have to write out 4 separate equations: one for June's 10 months, August's 7 months, October's 5 months, and February's 2 months. While this approach is precise, running 4 separate arithmetic strings creates a significant time sink during a test. To streamline this, we use the product method. It is designed specifically for irregular dates and amounts. Looking at this comparison, the product method simplifies the process. On the right, we take the withdrawal amount and multiply it by the months remaining to create a single product column. We then sum those individual products together. Instead of multiple equations, we apply the interest rate and a fixed time fraction of 1/12 to that single total sum. The results are identical. The product method yields $3,200, reaching the same conclusion as the 4 equations on the left with much less effort. This establishes our first rule of engagement. When dealing with irregular drawings, always deploy the product method to bypass repetitive arithmetic. Now let's change the variables to an equal interval problem. Suppose a partner withdraws exactly $1,000 at the beginning of every single month. Using the product method here would result in 12 rows of calculations. Even though it is faster than the simple method, it still requires unnecessary manual labor. For recurring intervals, we use the shortcut formula. The equation consists of 3 parts: total drawings, multiplied by the interest rate over 100, multiplied by the average time over 12. Note that the formula requires total drawings. A common mistake is using the single monthly amount of 1,000 rupees. You must multiply that by 12 to get the full annual figure. The only complex variable in this formula is determining the average time. You can find the average time without memorizing tables by using this timeline logic. Add the months left after the first drawing to the months left after the last drawing, then divide by 2. If a withdrawal happens at the beginning of every month, the first draw on April 1st leaves 12 months in the year. The final draw on March 1st leaves 1 month. 12 plus 1 divided by 2 gives us an average time of 6.5. If the withdrawal happens at the end of every month, the first draw on April 30th leaves only 11 months. The final draw on March 31st leaves 0. 11 plus 0 divided by 2 results in an average time of 5.5. By using this first plus last logic, you can solve for any monthly or quarterly interval without relying on rote memorization. To see how this works in a complex scenario, we will calculate the interest for a 20,000 rupee withdrawal made precisely in the middle of every month. First, we find our total drawings by multiplying the 20,000 rupee monthly withdrawal by 12, giving us 2,40,000 rupees. Next, we apply the average time logic. A withdrawal on April 15th leaves 11.5 months remaining. The final withdrawal on March 15th leaves 0.5 months. 11.5 plus 0.5 divided by 2 gives us an average time of exactly 6. Now we populate the formula. 2,40,000 multiplied by 10% multiplied by 6/12. The result is 12,000 rupees. Contrast this single-line calculation with the traditional methods. Without the shortcut, you would be forced to calculate a 12-row table using complex decimals for every month. You eventually reach the same $12,000 total, but the risk of a manual calculation error is significantly higher. The shortcut method condenses 12 lines of arithmetic into one equation. It eliminates the repetitive steps where most calculation errors occur. In summary, use the product method for irregular dates and amounts, and use the shortcut method for identical, recurring withdrawals. Always derive your average time using the first plus last rule. This logical check ensures you never have to guess. To test these methods yourself, I have prepared a practice problem. Using these irregular dates, May 1st, September 1st, November 1st, January 1st, and March 31st, calculate the interest on drawings at a 9% rate. Apply the product method to the data on screen. Post your final answer in the comments to verify your results and ensure you are ready for exam day.